Asset. Anything of value that you own. Assets put money in your pocket. Assets are your financial superheroes protecting you and growing your wealth. Your house, car, bank deposits, and stocks are all examples of assets. Even that vintage collection of Pokemon cards can be assets if you can sell them for cash. Liability. It is the opposite of an asset. A liability is anything that you owe. It's like the friend who always borrows your stuff but never returns it. Mortgages, car loans, credit cards, and many more things are common liabilities that people have. Net worth. The grand total of everything you own, assets, minus everything you owe, liabilities. Your net worth is like your financial Instagram profile. The more assets, the better the glow up. But if you're deep in debt, it's like posting a selfie with crow poop on your white shirt. Definitely not the flex you're going for. Pay yourself first. It's like putting on your oxygen mask before helping others. Sounds familiar? Imagine your paycheck is a cake. Instead of giving a slice to everybody else, like your bills or paying for coffee runs, take a slice for yourself. Let's be real. If you don't, you might be left with crumbs. Credit score. A 3-digit score that tells lenders how trustworthy you are with borrowing money. Its value ranges from 300 to 850. The higher the score, the more people want to lend to you and the more you will get a lower rate. Think of your credit score as the financial equivalent of your Tinder profile. If it looks cool and promising, lenders are going to swipe right. If not, rejection and rejection. And soon you will find your borrowing profile pushed to the cold storage of financial rejection. FICO score. It's your credit score as calculated by the American data analytics company, the Fair Isaac Corporation, or FICO. Capital. Money or assets you can use to generate more wealth. You need capital to start a business. It's the fuel that fires your financial rocket. Depreciation. Your car, your phone, or that fancy new TV you just bought. They will lose value the second you leave the store. Depreciation is the process in which your assets lose value over time. Appreciation. The opposite of depreciation. Sometimes assets grow in value. Think of Tesla stocks. They are now worth multiple times more than what they were over 10 years ago. That is an appreciation in stock price. Cash flow. The movement of money in and out of your pocket. When money is coming in, it's called positive cash flow. And when it's leaking out faster than you can plug its holes, that is a negative cash flow. Capital loss. When an asset becomes less than what you paid for it. Imagine you invested in a company's stock last year, but the value of the stock has tanked this year. The bad news is you've made a capital loss. Bond. A bond is an instrument for borrowing money from someone, but with a twist. When you buy a bond, you're lending money to a company or government that issues the bond. The bond issuer promises to pay you back with interest. Stock. A little piece of ownership in a company. When you buy stock, you become the owner of a tiny slice of that company. If the company does well, your stocks become worth more and you get richer. Stock market. The place where your stocks are bought and sold. A stock market is like a giant online marketplace for company shares. It's your chance to build wealth over time by investing in stocks. Blue chip stocks. Stocks from big, well-established companies with a solid track record and strong financial health. Think of them as the straight-A students of the stock market. Do you invest in one? Do let us know in the comments down below. Certificate of deposit, or CD. A CD is like a savings account but with a twist. You lock your money away for a set period of time like 6 months or a year, and in exchange, the bank pays you a guaranteed interest. 401k, a retirement savings plan that allows you to invest a portion of your paycheck before taxes are taken out, depending on the type of contributions you choose to make. In the United States, the 401k is the most popular retirement savings plan. In fact, it's so popular, more than 70 million Americans, or about 42% of the working population, have one. Investment. It's like planting a money tree by building an asset like a stock or real estate and expecting the price to go up. But don't forget that, like trees, investments take time to grow into something much bigger, so patience is key. Asset allocation. The strategy of allocating your limited money among various investment options like stocks, bonds, real estate, and other stuff. Dollar cost averaging. The strategy of investing the same amount of money in an asset like a stock at regular intervals. For instance, investing $100 every month in stocks no matter whether the market goes up or down. How does it help? Well, it helps you avoid the stress of timing the market. Rates of return. It's the report card of your investment. How hard are your investments working to make you richer? The rate of return shows the percentage of profits you made on your investments. Liquidity. How easily an asset can be converted into cash. The more liquid an investment, the faster you can sell it for cash without losing value. Mortgage. A long-term loan you take out on a house. Generally, you're required to pay it back, with interest, of course, in about 15 to 30 years. Will, a legal document mentioning what happens to your assets when you're no longer around to enjoy it. Think of your will like a treasure map. You leave clues for how your treasure, aka assets, should be divided between your loved ones. Salary. What your employer pays you for all your hard work and contributions. It's the paycheck you rely on to keep your coffee addiction alive and rent paid. Income. The flow of money you receive from various sources, like your job, investments, or even side hustles. Income is what keeps your bank account happy and your bills paid. Disposable income. It's your do-what-you-want money. Disposable income is what you're left after paying must-have expenses like rent and utility bills. Passive income. The income that you generate without all the blood, sweat, and tears. It's the automatic income being generated when you sleep. Think of royalties from a book you wrote, rental income from a property you own, or dividends from stocks. Passive income is the money printing machine that works when you are not working. Budget. A financial roadmap that helps you track expenses and stay on course. It's like having a GPS for your money. Without a budget, you might end up lost in a spending zone. Profit. The money you're left with after paying all expenses. If you're running a business, it's the profit that matters at the end of the day. Profit is often referred to as the bottom line. Capital gain. The money you make when you sell an asset at a higher price than what you paid for. So if you invested $1,000 in Tesla stock sometime back, and if your investment is worth $1,500 today, congratulations, you just pocketed a capital gain of $500. Dividend. It's the cash award that you get for holding stocks of profitable companies. Companies often share a part of their profits among shareholders as dividends. It's the company's version of a thank you card, but instead of a generic greeting, you get cash, sometimes more stocks. Social Security, a U.S. government program that offers retirement benefits and disability income to individuals who are eligible, as well as their spouses, children, and survivors. It's the government's way of saying, we've got your back. Credit. It's the magic pass of borrowing money from banks. When a bank offers you credit, it basically means you can borrow it from it hassle-free. But just don't forget that once you borrow it, it becomes debt and you need to pay it back with interest. Credit report. It shows the detailed history of your borrowing and shows your good and bad credit habits. Missed a payment? It's there. Paid on time like a champ? Everything gets reflected on your credit report. Credit card. The plastic or metal card that allows you to spend money that you don't currently have. It's like a temporary loan with perks until the bill arrives and you need to pay it back. Credit limit. The maximum amount of money you're allowed to borrow using your credit card. It's your spending boundary. Credit utilization. The percentage of your total available credit that you're using. So if your credit limit is $1,000 and you've already spent $450, your credit utilization rate is 45%. Borrower. Anybody who takes out loans. Debt. The amount of money a borrower owes to others. Debt comes at a cost called interest. Payday loans. Short-term, very high-interest loans that are typically due by the next time your paycheck arrives. Think of it as borrowing from your future self, except your future self might be a little mad when they find out how much you owe. Predatory lending. The practice of lending at a ridiculously high interest rate. Predatory lenders, for instance, many payday loan lenders try to trap borrowers with high interest rates. Debt snowball. The debt repayment strategy of paying off the smallest debts first. Once the smallest one is done, your target is the next smallest one. It's like starting with a tiny snowball and watching it grow as you crush each debt. Debt avalanche. The debt repayment strategy of paying off the highest interest debt first. It's like killing the biggest monster first so the little ones look easier to tackle. Bankruptcy. A legal process allowing individuals and businesses to deal with loans they can't repay. It's like a legal way of saying, oops, I messed up. APR, or annual percentage rate. The fancy term for the percentage of interest that will be charged on your borrowings or credit card spends. Annual fee. The fee your credit card issuer is going to charge every year for the privilege of using the card. It shows up once a year just to remind you that nothing is truly free in life. Savings account. The safe, reliable option for storing your cash with a bank. A savings account is like a financial vault where you can stash your money while it earns a little bit of interest. You can withdraw your money whenever you want. Checkings account. A bank account where you can keep your money for regular expenses like paying for pizza. It's like your wallet, but without the crumbled cash or any annoying coins. Debit card. A card that allows you to spend money that you already have in your account. So when a debit card declines, it's not because the card is tired, it's because your bank account is. Financial advisors. qualified people for people to approach for financial planning and advice. A financial advisor is like your personal money coach. Emergency fund, a fund in which people save money for emergencies and just-in-case moments. It's great to have one that covers 3 to 6 months of expenses, whether it's a flat tire or your friend's impromptu wedding invite. An emergency fund will deal with surprises. Life insurance, a financial instrument that ensures your family is financially taken care of when you're not around. It's not the most fun topic, but it's one of those better safe than sorry kind of things. Risk, the likelihood that something can go wrong with your investments. What if you wake up in a recession tomorrow and it wipes out the value of your investments? Risk tolerance. It reflects the level of risk you're willing to take. Some people are like James Bond. They are cool with high-stakes situations and daring moves, but then most people want to play safe with their money. Risk management. The strategy of dealing with investment risk. Investing without risk management is like driving without a seatbelt. You can still drive the car, but you definitely don't want to find out what happens when things go wrong. Risk averse. It's like being the Bilbo Baggins of investors, preferring to stay in the safety zone rather than jumping into unnecessary dangers and adventures. Many risk-averse investors stay away from high-risk investments like penny stocks or crypto. Diversification, the art of not putting all of your eggs into one basket. In diversification, you invest in different assets rather than putting all your money in one. Diversification is like skydiving with multiple parachutes. If one parachute fails, you've got your backup for sure. Index funds, a fund that tracks the performance of a market index like the S&P 500. Investing in an index fund is like investing in the broader stock market rather than a single stock. Exchange-traded funds or ETFs, a hybrid like stocks and index funds. Like index funds, ETFs track a diversified set of assets like stocks, bonds, and commodities. And like stocks, ETFs can be traded on exchanges. Trading, the process of buying and selling assets like stocks to make short-term profits. Instead of buying and holding for the long haul, traders buy and sell stocks, bonds, or other assets in hopes of making a quick profit. But here is a warning, most traders end up making losses. Penny stocks. Super cheap stocks typically price under $5. Most penny stocks belong to small companies with questionable business models or financial performance. Investing in penny stocks is like betting on an underdog at a race. You might win big, or you could end up crashing and burning all your money. Cryptocurrency, the fancy term for a digital currency or a type of money that exists only on the internet. If the world of cryptocurrency is a superhero universe, Bitcoin is like Superman, the legendary one. Taxes, the mandatory payments made by individuals and businesses to the government based on the income they earn. Taxes help fund government expenses, pay for public infrastructures like highway and healthcare systems. So while they're not the most exciting part of the paycheck, at least they keep the roads clear for your road trips, unless you live in South Carolina. Withholding tax, money that an employer subtracts from an employee's gross wages and sends directly to the government. Principal, the original amount of money that you borrow. Interest, the cost of borrowing money expressed in percentage terms. Interest is charged on the principal amount borrowed. Compound interest, the interest calculated on the principal and the interest accumulated over the previous period. It's like the interest on a double shift. In the case of investing, compound interest grows your money like magic. But if you're repaying debt, it can feel like the interest is multiplying faster than you can catch up. It's not the kind of magic you want when you're deep in debt. Annual percentage yield or APY, the magic percentage that tells you how much interest your savings will earn in a year, taking into account compound interest. It's like the real deal on how much your money will grow. APY is not just earning interest on the original amount, but also on the interest that you've already earned. Opportunity cost, the price you pay for choosing one option over another. Think of what happens when you choose to buy the shiny new iPhone instead of investing the money in Apple stock. The first option gives you a phone to brag about today, but no investment for tomorrow. The second gives you financial security, but nothing to show off today. Which one would you choose? Inflation. It's the reason why your favorite snack that used to cost $1.50 might now cost $2.50. It's the sneaky villain of which prices go up over time. And guess what? If your income doesn't catch up with it, your purchasing power takes a hit. Impulse buy. The habit of buying stuff you really don't need, often without a second thought. The happiness lasts a while until the credit card bill arrives and you start wondering how you ended up in a mini debt trap. FIRE, or financial independence, retire early. The idea of saving aggressively and building up an old nest egg so you can retire early. Think of it as a financial sprint where you hustle hard for a few years and cut back on spending, and then boom, you can retire in your 40s or even earlier. Now, if you like this video, check out my video on the best finance books. It will help you in your journey for financial freedom.